Welcome to The Explainer. Today, we're playing financial detective to figure out exactly why Wall Street's red-hot 5-day winning streak just suddenly snapped, and, more importantly, what this actually means for your money. If you've been watching the tickers flash red today, well, you know the market is shifting gears incredibly fast. So, let's just break down the evidence together.
The biggest question on everyone's mind right now is this. Are we just looking at a healthy, temporary pullback, a classic buy the dip opportunity, or is this the start of something much bigger and a whole lot more painful? To figure that out, we really need to dig into the numbers.
And the headline number grabbing literally everyone's attention right out of the gate? Negative 150. Yep, the Dow tumbled 150 points, snapping what had been a remarkably hot 5-day run. It's a pretty sudden jolt for a market that was honestly feeling quite comfortable.
But the damage definitely isn't just isolated to the Dow. We're seeing a broad hit across the board. The S&P 500 is off by 0.6%, the Dow by 0.4%, but the Nasdaq is taking the absolute heaviest blow, down 0.9%. Tech stocks are just getting hammered today. And as we'll get into shortly, there's a very specific reason for that.
So, to make sense of the chaos, here's our roadmap for today. First, the Wall Street sell-off. Second, connecting the macro dots. Third, sector rotation, figuring out the winners and losers. Fourth, a spotlight on Home Depot and Apple. And finally, number 5, the bull versus bear case. Let's get right into it.
Starting with Section 1, the Wall Street sell-off, or as I like to call it, the scene of the crime. The absolute first culprit we have to talk about, bond yields. They've suddenly spiked to 4.35%. In the financial world, a yield spike like this acts kind of like gravity on stock prices. Basically, safer government bonds suddenly look way more attractive than risky stocks. This is just brutal news for anyone banking on an imminent interest rate cut from the Federal Reserve, because it's a massive signal that money is going to stay expensive.
Adding fuel to the fire, literally, oil has just jumped to $82.50 a barrel. Now, why does this matter so much for the average investor? Well, because expensive oil is basically a direct tax on everyday consumers. When it costs you more to fill up your gas tank, you obviously have less money to spend on everything else, which eventually just eats right into corporate profits across the board.
Moving right along to Section 2, connecting the macro dots to see the chain reaction.
This whole situation really illustrates the domino effect perfectly. Step 1, jobless claims came in much stronger than expected at 215,000. Now, sure, that sounds great for the economy, but it signals a very tight labor market to the Fed. So step 2, because the labor market is so tight, traders instantly slash the odds of a September rate cut from 70% all the way down to just 55%. Which leads to step 3, borrowing costs get driven up. And finally, step 4, those higher borrowing costs directly hammer sectors that rely on cheap money and consumer spending, specifically tech and retail.
So the absolutely crucial takeaway here is that this specific combo, higher rates mixed with expensive oil, creates a perfect storm of market anxiety. It's a classic squeeze. Tech stocks sell off, retail worries spike because consumers are feeling the pinch, and money rapidly rushes for safety right into energy and banks.
Which brings us perfectly to Section 3, sector rotation, where we track the money to find the winners and losers. To really understand the market right now, you absolutely have to understand the concept of sector rotation. This is not some uniform sell-off where everything just drops equally. No, sector rotation is simply the movement of investment capital out of one industry sector and into another. And right now, we're seeing a textbook shift as money flows out of growth stocks, like your big tech companies, and rotates straight into value stocks and commodities.
The divergence we're seeing in the market today is just stark. On the winning side, energy is up 1.2%, obviously thanks to that oil spike we talked about, and financials are up 0.6%, mostly because banks actually benefit from those higher bond yields. But then you have the losers. Tech is down 0.9%, and consumer discretionary is taking a massive 1.1% hit. And the heavyweights that are really dragging everything down in those sectors, well, they're names you definitely know: Apple, Microsoft, Amazon, and Home Depot.
Let's drill down into a couple of those specific names in Section 4. Spotlight on Home Depot and Apple, the heavyweights stumbling.
First up is Home Depot, which is currently sitting down 2.5%. Now get this, they actually beat their earnings expectations, but the market punished them anyway because they went ahead and slashed their fourth quarter guidance. And the reason why is super important.
They cited weaker, do-it-yourself demand from consumers and the heavy burden of expensive lumber. Make no mistake, when Home Depot comes out and warns that everyday people are holding off on big home projects, that is a massive, flashing red flag for the broader housing sector.
Next up, we have Apple, which is also really struggling today, down about 1.8%. What's super concerning here is that this marks Apple's fourth consecutive losing session. Tech in general is broadly out of favor right now because, like we discussed, higher interest rates basically discount the value of a company's future earnings. But compounding Apple's macro problems are these fresh, anxious whispers floating around regarding slow iPhone 17 pre-orders over in China. So it's really this dual threat of macro pressure and product-specific fear hitting them all at once.
Now, it is not all doom and gloom out there in the corporate world. And Disney actually proved that yesterday by popping 3%. Even more impressively, they're holding on to those gains today. Why? Because their massive streaming business finally turned profitable, and they actually did it ahead of schedule. It just goes to show that even on really red days, individual companies that are executing well can still find buyers.
Taking a quick look at the technical side of things, the absolute critical floor to keep your eyes on is the Dow's 50-day moving average, sitting right at 39,650. If buyers step in right there while the Relative Strength Index, or RSI, cools off from an overbought 70 down to a much healthier 62, well, there's definitely room for the market to run back up. But if we break below that 39,650 level on heavy trading volume, watch out, because the next target on the way down is 39,200.
All right, wrapping things up with Section 5, the bull versus bear case, and how this whole thing might resolve. So here's the bottom line, pitting the two scenarios side by side. The bull case relies entirely on those dip buyers stepping up right at that 39,650 support level we just talked about. For this to work, the bulls absolutely need bond yields to stabilize. If they do, they could push the Dow back above 39,900 by today's close, which sets up a nice climb back to 40,500 by Friday. On the flip side, the bear case is betting that hawkish Fed fears and climbing oil prices are going to shatter that critical support. If that happens, the bears are looking to drag the market all the way down to test 39,000, probably in the next 2 to 3 sessions. Based on everything we've unpacked in the explainer today, from that unexpectedly tight labor market to the clear weakness in retail and tech, the intraday odds are currently leaning 60% bearish and 40% bullish. So, for the moment at least, the momentum is definitely favoring the sellers.
As we track how this plays out for the rest of the day, here's your exact timeline. We had the 9:30 a.m. morning drop, we saw the midday testing of our critical support line. But literally everything hinges on 2 p.m. That is when we get highly anticipated comments from a key Fed speaker regarding those unexpectedly hot jobless claims.
So, as we wrap up this explainer, I'm going to leave you with one final thought to keep your eyes glued to. Will that 2 p.m. Fed commentary soothe trader anxiety and flip the script back to a rally, or is oil creeping up toward $84 going to act as the fatal trigger for a much deeper, broader market sell-off? The evidence is all right there on the table, and the market is just about to render its verdict. Thanks so much for joining me on this deep dive. Stay sharp out there, and I'll catch you next time.